You think cash flow comes from selling cars? Wrong. Tesla's best-selling product was never the car. It was a future people were willing to pay for up front. And here's the harsher truth. On Wall Street, a good story can monetize faster than a good product. Picture it. Money surging like a tide. Worship today, dumped tomorrow. Banks are whining. Funds are trampling each other, and interest rates slice through companies like razor wire. Most automakers survive this by borrowing oxygen. Tesla doesn't. Tesla turned the capital markets into its personal supply depot. The public story is simple. Tesla wins because it's ahead on tech. It scales faster, and its gigafactories print money. Musk is the genius engineer steering humanity into a cleaner future. Great narrative, except for one problem. If Tesla were just selling cars, why did its cash position look strongest when it was supposedly burning the most? The truth usually isn't in the steering wheel, it's in the balance sheet. Have you ever considered this? If the future itself can be collateral, who needs profits right now? Here's the dirty secret. Tesla treats valuation like cash flow. When the market prices you based on a decade of imagination, you can use your stock like an ATM. The higher the share price, the lighter the dilution. The more cash you raise, the more convincing the story becomes. The more convincing the story, the higher the share price. It's a beautiful self-reinforcing loop. You think you're buying an automaker's future. You're actually prepaying the down payment for its expansion. But that's just the appetizer. Because Tesla has another kind of money that shows up with barely any manufacturing at all. It's called regulatory credits. When other automakers can't meet emissions rules, they buy credits to stay compliant. And Tesla happens to have plenty. In some years, it's been worth billions with absurdly high margins. So what happens? The market starts seeing an illusion. Profits look steadier, cash looks stronger, and valuations feel safer to push higher. The dark joke is, sometimes it's not the cars making the money, it's the rules. And the angrier version is, you think you're rewarding innovation, but you're also rewarding whoever is best at gaming the incentive structure. And then you get that surreal moment. One side is still expanding, still pitching an even bigger vision. The other side, capital, rushes in like it's under hypnosis. Every tick up in the stock price adds another floor to an air-built skyscraper. Tesla uses that sky-high valuation to buy real-world factories, secure supply chains, attract talent, and even hijack competitors' attention. So don't treat this like celebrity gossip, because this capital magic quietly changes the cost of living in your world. Once a company proves that stories can convert directly into cash, the whole market learns the playbook. Pitch the vision, raise the money, expand first, figure out profits later. Maybe you get faster innovation, or maybe you get a bigger valuation bubble and the risk eventually leaks into your index funds, your retirement account, and your credit cycle. More concretely, ownership becomes subscriptions. Products become promises, and we'll deliver later becomes a business model. And when promises slip, the cost rarely gets refunded to you. It gets transferred into the next price hike, the next rate hike, the next drawdown. Here's the punchline. Tesla's strongest moat might not be batteries. It might be its ability to make capital believe. Next episode, we'll go darker. When every company learns to tell stories, who's the one who turns off the lights and walks away at the very last second? Don't blink.